Hi everybody, this is Mr. Farmer, and today we're talking about consumer and producer surplus and dead weight loss. Alright, here we go. So I think a very valid question first off is, why do we care about this thing? Well, for consumer and producer surplus is shorthand for PS, consumer surplus CS. You're going to want to know those because we will be using these in graphs. We're identifying them in areas later. So what they do is they help determine if an industry is efficient, specifically if they are allocatively efficient. Now the textbook has a definition. If you read lots of textbooks, it'll probably say when the two areas are equal, that is allocatively efficient. If they're not equal, it is not allocatively efficient. I tend to not like that definition, and I'll show you why later. I think it makes sense. So what I use is if the area of consumer surplus plus producer surplus, if that area of the combined sum is at a maximum, the industry is allocatively efficient. Now, allocatively efficient, if you don't remember, is a property of an efficient market whereby all goods and services are optimally distributed amongst buyers in an economy, meaning at a price that's still okay with the producers. They still have to agree, the whole freedom of exchange market scenario. The producers have to agree to the price, and at that price, the most amount of consumers will be able to buy the product. If that occurs, the market is allocatively efficient. They're producing it for all the people, while again still being okay with the producers. So that's why we care about this scenario. So, what are these things? Consumer surplus. The benefit surplus received by consumer or consumers in a market. Okay, vaguely helpful. What's that look like? The difference between the maximum price a consumer is willing to pay. How do we know what consumer is willing to pay? The demand curve. Again, in order to demand in economics, you must be able to pay, one, and two, willing to pay. So the demand curve identifies the consumer's willingness. So it's the maximum price a consumer is willing to pay for a product versus the actual market price. So let's go to an example. I think examples are definitely helpful. We got Johnny. Johnny's willing to purchase the first unit, and they think it's worth $11. They get $11 of benefit out of it. There we go. So what if the market price is $6? How much additional benefit did Johnny get beyond the price? Well, again, Johnny believed it was worth $11. He gets $11 of use out of this thing. They only had to pay $6, so they get an extra $5 of benefit by buying this good at the $6 price. We call that consumer surplus. That the $5 is the additional amount of surplus benefit to consumer or consumers. Now, Johnny's not the only consumer. So let's take a look what it looks like graphically. So here we have our graph. Johnny was willing to spend $11. They only had to pay $6. And so we get a difference of $5 for that one person. That's, again, the additional benefits. So there's Johnny. But you can see there's more willingness. So the next person says, I think it's worth $10. I want to pay $6. So they get 4 and 3 and 2 and 1. And if we add all that area here, you can see a little triangle forming. This area is what we call consumer surplus. So it's thinking about that top area. Again, the demand curve shows us the willingness, so I'm looking at the willingness of the consumers compared to the actual price, and so I can get this whole nice area on there. Now, you might be asked to mathematically prove what this is, and so you just do base times height divided by 2. So for the height, 11 minus 6, 5, times quantity of 6, times 1/2 divided by 2, whatever, equals a $15 value. So that's consumer surplus. That's it. How about producer surplus? The additional surplus benefit a supplier receives by providing the good at the market price. The difference between the actual price a producer receives and the minimum acceptable price. Again, how do we know that minimum price? Supply curve. Are they willing to produce it? So we got Jimmy. Jimmy says, I'm willing to sell this good at $1. I get to sell it at a market price of $6. So how much additional benefit did Jimmy get beyond the price? Well, In order to cover the cost, they needed to charge $1. They're able to charge $6. They get an extra $5 of benefit beyond. So that $5, that additional amount of money, is the additional benefit the producers receive, or the surplus benefit. And since on the supply side, we call it producer surplus. So think about it like they get an extra revenue stream they weren't thinking of, is the idea. So we have Jimmy. Jimmy says, I'm going to sell the first unit for $1. Was able to sell for $6. It's an extra $5 of revenue beyond what they're willing to do, beyond their willingness. That is the producer additional surplus benefit, or producer surplus. So here we got Jimmy, and there's their $5 of additional surplus benefit. But again, they're selling more than one unit, or there's more than one seller. So we got the other ones also here. And if we add all those areas up, what we find is this area right here, which is the producer surplus. So consider this. Is there a price at which the areas of the blue and the orange would be any larger? No. The best output for this market is $6, or is $6 at a quantity of 6 units. If you charge $7, well, then only 5 people would buy the good because it's too high of a price. Well, if you went down to $3, then only 3 people would produce this good. So a $6 price means the most amount of people are purchasing this good, and I can identify that because we are allocatively efficient. My consumer and producer surplus are at their peak. Now, the textbook said when they're equal, you're allocatively efficient, and I told you I didn't like that. Here's why. Well, if you think about elasticity. So these two graphs have an elastic, or a more inelastic demand curve and a more elastic supply curve. So these two areas, the yellow and the green, are not equal, and over on the right hand side we have an elastic demand curve and an inelastic supply curve, and the yellow and green areas are not equal. And yet these two markets are allocatively efficient. There's no other price point that would get a larger amount of consumers to buy the good. So even though they're not equal, we're still allocatively efficient. That's why I prefer the definition of consumer surplus plus producer surplus. If it's at a maximum sum of the area, you're allocatively efficient. Now, while I have this up here on the supply and demand and elasticity, let's kind of combine a previous topic with the elasticity. That's the idea of burden of tax. So with burden of tax, we had an increase of tax onto the producer, and so we have a per unit tax. Again, we look at the new quantity and we go S plus tax minus S, and what we end up with is the per unit tax right here. What we can see on this visually, hopefully, is that the person or the side of the market that's more inelastic, they're going to take on the larger burden of tax. So the more inelastic, the higher the burden of tax. By definition, how does that work? So because the supply is inelastic, they're less responsive to price changes. So when there's an increase in the taxes, they can't respond as much. They have to take on a lot of that burden, whereas the consumers are highly responsive. If you increase their price at all, you're going to lose a lot of them, so you can't charge them that much. On the right-hand side, the consumers are very inelastic. This would be like a gas tax, a tobacco tax. You can push that burden of tax a lot onto the consumers. And the producers, they don't need to generate as much money because they're more elastic by their very nature. So whoever's more inelastic will take on the larger burden of tax. So again, this is where we can see we're combining an old topic, burden of tax, with a relatively newer topic, elasticity. All right, last topic for today, dead weight loss, DWL. It's another area we're going to find on the graph. Dead weight loss is the reduction of combined consumer and producer surpluses. It's associated with an underproduction the vast majority of the time. Later, we're going to talk about a thing called negative externalities. And so let's go back. It was at $6. What if instead there was a price floor imposed at $9? Let's see what happens. So here we have our graph. We have our consumer surplus in the blue, producer surplus in this red, and you can see it fills up this whole area. So there's our new price floor at $9. Eventually, we're going to add in the new consumer surplus, the new producer surplus, and there's going to be an area left over that is currently shaded in by the red and blue that is not going to be, and that's going to highlight the dead weight loss. So again, the consumers show you, the demand curve shows you how much consumers are willing to pay. I was willing to spend $11. Now I get to spend $9 instead of 6. So I only gain 2 and 1 and 0, and I don't get to buy anymore. Have the new producer surplus. Well, I was willing to sell for $1. Now I get to sell for $9. I get $8 of benefit. That's awesome. I get $7. I get $6. I get to not sell the goods. So we have the producer surplus up here in yellow. Now the producer surplus, I haven't done the math, but it could be larger, to be honest. But here's the area. The sum of the two spots is no longer maximized. You can see this little area, this blue and red still left over, that's no longer filled out. That green area now is what we call dead weight loss. That's how inefficient the market is. So dead weight loss existing proves that we are not allocatedly efficient by definition. It is a dollar value in the same way the consumer surplus is a dollar value, so you could calculate that. Okay, not usually asked. You usually ask if it's increasing or decreasing based on circumstances. Now, for right now, dead weight loss occurs because of a price floor, shown here, or a price ceiling, shown here. So the price ceiling, you can see at the price ceiling, here's our new producer surplus, here's our consumer surplus, and this yellow area is our dead weight loss. Whereas before, we had this is the kind of lighter colors, our consumer surplus. This darker area would have been our producer surplus, and we're missing out this dead weight loss. So for right now, dead weight loss is created by price floors and price ceilings. Later, when we start talking about different market structures, like monopolistic competition, monopolies, dead weight loss is going to naturally occur. So why do we care? Why do we care if a market is efficient? Well, what are the products with something like healthcare? Let's make it available for everybody. Let's make it super cheap. Well, then we have dead weight loss. We have an inefficient market. Unless there is government subsidies to fulfill that need, we have a shortage. So that's a very real and very serious conversation. What if instead it was a price floor put on things like food for agriculture? Unless you cannot charge below this price. Why would the government ever do that? To make sure the farmers can make enough of money to make a living off of it. Because if they can't make a living, then they're not going to produce food. And again, that's a very serious conversation. Now again, these are very large topics, and this is a very simplified graph. So no, this is not the entire conversation at all. But you can see with this concept, you can highlight very big conversations, and then you can keep going with this to see what works out for you. So this is definitely a very big conversation. So hopefully we now understand consumer surplus, producer surplus, and dead weight loss. Those are kind of the big topics today, but we also checked a little bit of burden of tax with elasticity. All right, until next time, bye.